All right, so this is going to be controversial. And I'm probably going to get hit by trolls. We're going to say, Paul, you're avoiding the problem. You're trying to focus on something to hide the fact that your stocks have gone down, that we've had a poor year in 2021 and having a poor year in 2022. And that's okay. That's okay. I feel like this is important. And so I'm going to make this video, even though it's a little bit complicated and it's a little bit difficult, but I think it's important. And most of all, you're not reading about this anywhere else. I mean, you can go all over YouTube, you can go all over Twitter, you can go all over the Wall Street Journal, New York Times, unless you're very, very sophisticated and reading a lot of news sources like the way I read them. I doubt you would get this. So let me start off with this article, which is from December 16th of 2020. And we're going to put up the headline, which goes, America's zombie companies rack up $2 trillion worth of debt. And it refers to the period sort of right after the Federal Reserve cut interest rates and said that they were going to really intervene in markets so as to keep them liquid. And so it stimulated a borrowing boom. And this article says that the borrowing boom amid the pandemic reshapes corporate finances. And then it gets to the part that is problematic. It says, surge in zombies expected to weigh on US economy for years. I'm going to read a little bit from the text of this article, which is behind a paywall at Bloomberg. So I'm just going to read some of this because it's important and it gets to the heart of a number of things that I'm going to get to. And I just want to give you fair warning. This video is going to go on for some time. So if you're not interested, don't care, then you know what? It's just time to tune out and find something different to do. All right. But so Bloomberg says they were once America's corporate titans, beloved household names, case studies in success. But now they're increasingly looking like something else, zombies, and their numbers are swelling. And then the article goes on to name some of these zombie companies. And these are big companies, brand name companies that you think of as being blue chip stocks. Not all of them, but many of them, all right? From Boeing, Carnival Corp, Delta, to ExxonMobil and Macy's, many of the nation's most iconic companies aren't earning enough to cover their interest expense, a key criterion as most market experts define it for zombie status. So let me just explain what this criteria is. In other words, when a company goes to the bond market and borrows money from investors that give them money, and in exchange, the investors get a promise that the company will pay it back in 3 years, 5 years, 7 years, 10 years, 15 years, 20 years, whatever the number is. And then they also get interest payments. And those interest payments have to come, you would hope, from the company's operations. So Bloomberg went and looked at the company's interest expenses, and then they went and looked at their earnings, which are driven by sales and then by cash flow. And they computed that these companies actually, based on the amount of debt that they have, they can't pay their interest expense. So in other words, they then are forced to do one of three things. One might be to cut costs to try and generate more cash from their existing operations, borrow even more to sort of kick the can down the road, if you will. So also going to update some of the numbers that are here. In the analysis that's in this article, they put up this picture, and we'll put up this chart. It says undead debt, and this is dated. So I mean, these numbers have gotten worse. Truthfully, I lack the wherewithal or the team or the staff to be able to update these numbers. The graphic says zombie firms are sitting on an unprecedented $2 trillion of obligations. And you can see that these numbers are pretty stark. The chart goes on to show that over 700 firms in the Russell 3000, which is a very large index made up of companies that of all sizes, 700 face interest coverage ratios below 1. So in other words, they're not making enough money to pay their debt. And going back to the companies that they mentioned, which is Boeing, Carnival, Delta, Exxon, and Macy's, I just went back and updated the amount of debt that they had before the pandemic started, and then where they are at the end of December 2021. Boeing, when the pandemic started, had debt, long-term debt of 19.8 billion. By the end of December 2020, they had 61.75 billion, and they seem to have paid off, or some of it has become current. So it is slightly less at the end of December 2021 at 56.7 billion. Carnival had 9.68 billion at the end of 2019, and it jumped to 22.13 billion by the end of December 2020. And today, as of the end of December 2021, it's at 28 billion. So it's jumped by 19 billion. Delta had debt of 8.87 billion as of December 2019, 27.42 billion as of December 2020, and 25.14 as at the end of 2021. ExxonMobil, 19.24 billion at the end of 2019, 24.67 billion at the end of 2020, and an amazing 45 billion at the end of 2021. And finally, Macy's, and these numbers were a little bit difficult to piece together because it does look like Macy's increased the amount of debt. However, this does seem to have been somewhat short term. So if you go and look at the numbers, you might find slightly different numbers for Macy's, but it looks like they started 2019 with what, 5.1 billion. It does look like, at least per the numbers that I came up, that they had slightly less debt in 2020, even though there are other borrowings that don't show up under long-term debt. However, at the end of December 2021, they're still at something like 4.44 in long-term debt. And based on quick analysis, what has happened here is actually even more distressing, in the sense it seems like more of the debt has now become shorter term in nature. In other words, they're going to have to pay this back sooner rather than later. And if what I'm about to go over with you is correct and is right, and this is a set of tweets that I did yesterday, and I started one tweet stream by sort of putting this article out. And I said, while the headlines are about inflation, this is the problem that is going to matter looking forward, and which is going to set interest rates and markets in the future. And just to go back to this article again, this article ends with some analysis, which today seems, like these people are delusional and dumb and stupid, like I'm being seen as now, because of my call to believe that this inflation is temporary. Interest rates are going to go back to quite low levels, negative levels. They're already negative levels, more negative levels. And the article from Bloomberg says, still corporate deleveraging in the years ahead will result in slower growth, subdued inflation, and low rates for as long as the eye can see. I'll repeat that. So the end of the analysis, after showing people the data, people who are in the fixed income markets, who are very sensitive to inflation, because that destroys the value of what they're going to get back when they lend money in the bond market. They're also very sensitive to credit risk, because that means they're not going to get their money back, because the risk that they face is that the company cannot afford to pay them back. And I believe that this is the actual risk that is there in the market. And in one of my tweet streams, I wanted to connect as to why this is important to us. That's because there's a lot of data, and I'm going to run through that tweet stream next, that is signaling that the bond market is no longer willing to buy the bonds of Boeing and Carnival and Delta and others that are zombie companies, because they can see that these companies are running out of time. And if the Federal Reserve is talking about raising interest rates, they are like, hey, we're not going to buy your bonds. And that is going to represent a significant risk for these bondholders. And the reason why this matters to us is that if that is right, that means there is a big shift coming actually in terms of the stock market and in terms of liquidity, where people are going to want exposure to growth again, because the growth companies, as I have mentioned, don't have large amounts of debt, because nobody would lend money to a growth company because they lack the kind of like long-term history that bondholders want. They lack the very stable free cash flow characteristics that bondholders want. And most of the companies are still unprofitable, reinvesting all of their money, usually raising money in the stock market to fund their operations. So I believe that we are setting up to see a massive reversal soon, where really these blue chip companies, some of which are, seen as steady Eddie dividend player stocks, are going to go through a transformation as being, quite dangerous from their current status of being safe. And then our stocks, which have been tarred as being risky and dangerous and somehow, terrible, set up to fail, they're going to see the flow of money come in and bid them higher. And this process seems to have started already. And the next tweet stream sort of goes into why this would appear to be the case, which is that these cracks that have, appeared in Boeing and Carnival and ExxonMobil and others is spreading. We have seen this in the last quarter, and I've briefly touched on this, which is that stocks like Clorox, 3M, Honeywell are making 52-week lows, when really that is dissonant with the market. When you go look at their financials, they are showing similar kind of sort of credit risk pressure. These are companies that have borrowed a lot of money, and now the market can see that they're going to struggle to make their interest rate payments. And you can see this if you go look at this chart that I put up, which is current data, which I actually got from a Financial Times article. And it says, investors are pulling money from US high yield bonds. And high yield bonds mean that they're paying more. The people who are selling bonds in the high yield market usually have to pay a much higher interest rate than investment grade bonds. And oftentimes this is the place where people will start to shed risk. In other words, sell their holdings. And that is exactly what has been going on from some number of weeks now, as you can see by the chart. The next thing that you can see that is pointing to the fact that this is unfolding as we speak is that the higher quality corporate bond market, as evidenced by this ETF, which has the ticker symbol LQD and is the iShares box investment grade corporate bond ETF, is now showing a 1-year loss. And you can see the chart here of nearly 6%, which doesn't sound like a lot, but I can tell you for the bond market, that's a big deal. For investment grade corporates to show that kind of loss, that's telling you there's some serious pressure. Now, what I believe is going to unfold and is actually unfolding is that there is actually a giant search now for money that is exiting bonds, who have seen these corporate bonds issued by these supposedly safe haven companies as being safe yield, someplace where you can go park your cash, and also from dividend paying stocks. Like there are a lot of people talking about, now's the time to buy dividend paying stocks. I would tell you that you're putting yourself in peril. Opinion, not advice. I just want to make that 100% clear. Opinion, not advice. Because if my analysis is right, and these companies are facing serious financial pressure that you can actually now go see on their balance sheet, on their income statement, on their free cash flow statement. So where is this sort of like money that is sloshing around likely to go? Well, I believe it's going to go, one place can go is to US Treasuries, because, hey, the US government, plenty of demand still for US Treasuries, despite fears about inflation. The 10-year bond still is far better returning than any other 10-year bond from any other country, whether it be Germany or Japan or any place else. And so there is a absolute market for it. The other place is mortgage bonds backed by our real estate markets, backed by 30-year mortgages over the vast history of time. That has been a reasonable place where people have put money into. Again, opinion, not advice. I'm not telling you to do anything. I'm just telling you these are the places I see. And then some of this cash is simply going to be forced up what I call the risk ladder. They are going to say like, hey, I can't put that much money into treasuries because the yield is too low. And I can't put that much money into mortgage bonds either because like I'm going to end up bidding these prices higher and I'm going to get lower and lower returns. So they're going to be forced to come and buy growth stocks and small cap stocks because those are the stocks that have been innovating. Those are the stocks that can grow as a result of innovation, new markets that are unfolding as we speak. And they just don't have these problems of America 1.0. And in the tweet, I anticipate an objection that people have. It's like, well, Paul, why can't people just stay in cash? Well, because interest rates in real terms, after you subtract inflation, has been negative really for many years now. I mean, you don't necessarily experience it that way. However, if you're getting, let's say, 0.1% at the bank and inflation is 2%, your actual rate of return is negative 1.9 after counting for inflation. So if you're managing billions of dollars, trillions of dollars like BlackRock or something, it's like you can't leave the money in cash. You have to try and get some kind of return that at least gets you at a lesser loss or break even, or if you can, positive returns. And you add one more layer to this, that if you imagine that the Fed is going to see these problems starting to happen in the bond market, these cracks that are appearing with Boeing, with Carnival, with ExxonMobil, with Clorox, with 3M, and other companies as they report, well, at some point in time, sooner rather than later, in my book, and by my bet, they are going to come off their current track to want to raise interest rates as much as they want to, as fast as they want to, and as well think of the potential impact of what it's going to have on these zombie companies and think that there is going to be a significant impact. And you can tell that the bond market, and I can tell you that the bond market is very sophisticated. There are far fewer retail investors in the bond market because they're difficult to buy. These are high ticket stocks. High ticket investments. Every bond is denominated at $1,000. So you can't buy and sell very easily. And so this is a much more sophisticated market. And the folks in this market, they are buying insurance using credit derivatives. And that means that they are looking at the scenario and they are seeing risk. They are seeing risk and they are starting to actually go and buy insurance so that if this starts to come undone and they are facing credit risk, that they get paid for it. And there is a market for these kinds of derivatives that you can buy, that these sophisticated investors know about. And you can see by the lines on this chart, this is what's doing. Bottom line to this entire video, not gloom and doom about our stocks. I believe that this is setting up for a very, very, very bullish scenario for us. Because at the end of the day, and this was in my previous tweet stream, what is seen today as a unmitigated sort of benefit and a plus and a good thing, like a halo, which is, oh, a dividend stock, a company that is buying back stock, has a major problem if they are not supported by their underlying business. If that dividend is supported by a stock that has been bought back using debt, and if the company is incapable of paying their interest income, well, the bond market is getting ready to say, hey, no more. We are full. We ain't going to buy it. We ain't going to buy more. And now begins a problem for them because, hey, they need to keep refinancing those bonds. And the market says no more. Major problem for those companies, for those stocks. However, given that there is plenty of cash in the system, I saw a number that says something like $1.8 trillion in the system. I don't believe there's going to be a systemic crisis of any kind. Instead, what you're going to see is, I believe, a massive asset allocation shift away from these kinds of corporate bonds of companies that are zombies, their stocks, which many people own for their dividends, and into growth stocks, America 2.0 stocks, fourth industrial revolution stocks. And then the other place that it's going to go to is crypto. So I know this was complicated. I know this was long. However, I felt it was important, and so I wanted to make this video. I know that some of the tweets might come across a little bit jumbled. For me to read every single tweet would have been probably too long, too difficult. Nonetheless, I hope you get the gist of the point. There is a major transition that is unfolding, not going to unfold, unfolding away from zombie companies, their bonds, their stocks, into growth stocks are companies because they don't have the issues that these companies have, which is essentially what we've been telling about. They have no growth. And as a result, they really have no long-term future. And I believe that that is going to lead to a massive allocation into growth stocks because they don't have those problems, and into crypto, which is exactly where we are positioned. So I am still very bullish, very optimistic, very positive, and I would tell you, if you are in our stocks, be strong hands. Hope you liked it. Come back next week. This is Paul saying bye.